All right, I'm Michael Hartzman, and today is Tuesday, February 17th, 2026. And I'm on, as always, with my partner, Dominick Tavella. How are you, Dom?
Doing well, Mike. Sitting in the Florida sunshine, so a little bit better than I was a couple of weeks ago.
Well, you know what? So are we. It's a balmy 42 degrees right now, and the sun's still up.
Compared to
So
when I left, Mike, that is truly balmy.
I'm sorry.
Compared to the temperature I left there when I left New York, that is downright Sahara Desert weather.
Absolutely. And you're down in Florida, and to me, the first sign of spring is always when pitchers and catchers show up, and pitchers and catchers have showed up. So spring has to be not too far behind.
Hopefully, the worst is behind us, Mike.
Absolutely. So, look, before we jump into it tonight, you and I spent a lot of time over the weeks talking about artificial intelligence. I just want to clarify 2 points for our listeners. Not that we imply that we ever use AI to give for investment advice, nor do we use AI for research that we don't check personally if we ever do and we don't. So I just want to make it perfectly clear that we use artificial intelligence as a tool amongst other tools, but we do not make investment decisions, give investment advice, or investment recommendations based on ChatGPT or other AI software.
Couldn't agree with you more, Mike.
Perfect. So jumping into this week's action, this morning on our morning call, you said that after last week's activity, the S&P was flat. And normally what does that mean? It's down a point or less or up a point or less. But literally, after 6 weeks of activity, the S&P is exactly where it started as of last Friday, as it was January 1st, which is virtually impossible.
I mean, like zero. So,
Zero.
so the bad news in that comment, Mike, is that we were up quite nicely on a year-to-date basis, and over the last 2 weeks, particularly, we've given pretty much all of it back, and so the S&P basically zero returns year to date. And I'll let you talk about the other major indices, but that one's I saw it myself, triple zero on a total return number, and I went, wow, that when was the last time I saw that? So
Yeah, exactly. January 1st. That's the last time you saw that.
yeah, there you
Yeah.
go. On a year-to-date basis, yeah.
Exactly. And the Nasdaq year to date is down a little around 3% as of Friday's close. Today was market was up. So that number is a little better. And the Dow Jones, actually Dow Jones is up year to date a little bit more than 3%. But Dom, I think the headline's buried in that the Russell 1000 value is actually up almost 6.5%. And the European markets and the emerging markets are still, like last year, leading the pack. The EFA is up 7.82, and the emerging market index was up almost 11.
Yeah, Mike,
So,
and I want to tie this into your comment about the Dow Jones. So if we break down the S&P 500, we've talked a lot about this. About half of it are value dividend-paying stocks, and about half of it are these growth stocks, and we've talked a lot about them. Well, growth stocks in general are down in almost 7-8% year to date. The value sector is up about 7-8% year to date. And if you split the baby, that's how we get about a zero return in the S&P 500. Value's up, growth is down. And the Dow is mostly value stock, so that's why it's up about 3% year to date.
all right. So I'm going to use an old Brooklyn expression. So value stocks down for the longest time, and I know you hate this expression, was like the redheaded stepchild of the market, and growth was where it's at. So, what is happening that growth is taking a back seat, and all of a sudden, value is looking fairly attractive these days?
Yeah, Mike. So again, a lot of topic that we've covered, but especially over the last couple of years, if you didn't own growth, and we talked about the Magnificent Seven and these large tech stocks, and a lot of them tied into artificial intelligence and investing in that. If you didn't own that sector, you kind of missed out on a lot of the return. This year, it's been the exact opposite. And so these tech stocks have really gotten beat up pretty hard. And we covered it this morning, and for our guests, we're covering it tonight. You can look at some of these major Magnificent Seven stocks. Some of them are down 10, 15, some of them as much as 25% from their all-time highs. So this year it's all about fear on the artificial intelligence tech side of the equation. And that money's got to go somewhere. That money's been going into interest-bearing bonds, safety, and the other portion of it is going into these high-quality dividend-paying stocks. These are economically sensitive stocks. And since the economy is relatively speaking good, those companies are performing relatively well.
When you talk about fear, normally everything gets thrown out with the bathwater, right? Everything goes, everything's gone, and so is it fear in general, or just that these tech stocks got a little too frothy and they're just taking a breather? Obviously, you don't know the answer. I don't know the answer, but I much prefer it this way than the market having just a general sell-off, which can still happen and not uncommon.
Yeah, Mike, I think you're bringing up a very valid point. Normally, when we're talking about fear, it might be a global geopolitical event, right? It might be the economy going into a recession. But in this case, it's really a conversation about all these companies making just ginormous investments in artificial intelligence, whether it's the chips, the data centers, the processors, right? So the first question is these very large investments, we're talking about approaching $1 trillion worth of capital investments, and the Googles of the world and the Metas, right? Is this investment a prudent investment? Is this investment eventually going to pay off? Are these companies actually going to make any money making all these investments? And now we're questioning all that, right? The markets are going, oh, wow, is this a really prudent investment? Is it going to pay off? And of course, we don't know what industries are going to be affected and how much those industries are going to be affected by artificial intelligence. So it's more a fear of the unknown as opposed to, oh my God, the economy is going to collapse, or we have a geopolitical event. And we think that picture clarifies itself, but how much and when, $1 million question.
Yeah, we talked about this last week and 2 weeks ago. Whenever you say that, Dom, it reminds me of MySpace and AOL, right? And where AOL was state of the art 20 years ago, and now when you see someone with an AOL email address, which I think you may still have one, well, like, really, you still using AOL? So that's what I think you're kind of alluding to, that there will be winners and losers, and we just don't know who they are at the moment.
Yeah, and a point, Mike, we've made many, many times. We don't believe that artificial intelligence in itself is a bubble. On the other hand, companies that are investing in that space, will they eventually be able to make a profit or be profitable in that space? We don't know who the winners and the losers are going to be, right?
Exactly,
And I think
but
that's what the
but
market's trying to figure out right now. Who are the winners and who are the losers going to be?
yeah, look, and I still think it's too soon. We're not going to know for years, right? I still maintain that, but I think what's also important, and the reason the market isn't completely cratering, is simply because economic experts, economists, analysts are still predicting a growth rate for the year of 2.5 to 3%, no recession, and at least two interest rate cuts, which is way less than the president would like to see. But I take that as a positive because it means the economy is healthy. So yeah, it's not all doom and gloom by any stretch of the imagination.
And I'm glad you brought that up, Mike, because I think you're making a valid point. There's all this just immense focus on technology and this artificial intelligence story. But you just brought up, the economy is growing at a pretty good clip here, right? Corporate earnings so far this year have been pretty good. I mean, most people would argue that they've been above expectations. And the one big, we don't know fear is inflation. The last number we got was not terrible, right? It's still trending downward, right? Not as good as we want it to be, but still trending downward. So yeah, we have this big unknown in front of us, and it really is a big unknown. I'm not discounting it, you know. But having said that, overall the economy's in a pretty good place. And the rest, how many times have we talked about this, Mike? The other 490 stocks in the S&P 500, for the most part, they're holding up pretty good.
Yeah, and look, we're not going to name names, but even those stocks, we who are getting beat up and down, as you said, 20-25%. Even their earnings were not terrible. They just weren't perfect.
Yeah, and I'll kind of remind everybody, you know, because we get it a lot, right? Mike, how many times do you get, you know, why don't we own this? Why don't we own that? And upper th or why don't we own more of it? Well, the stuff that most people wanted to own last year is exactly the stuff that probably would have hurt you the most this year.
Exactly. You're right. So look, it's a good place to stop because we have tonight we have an investment strategist from Schroders in collaboration with Hartford Funds. They've been great to us over the years, a great supporter of the show. So we have Dan Suzuki, CFA, Chartered Financial Analyst, coming up next. And Schroders, we love having Schroders on, Dom, because they bring an international view, both domestic, both developed and emerging market, which we talk about it, but it's always great when we get an expert on who can really speak to these topics, among other things domestically. So we'll be right back with Dan Suzuki, CFA and investment strategist at Schroders. All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our guest this evening, Dan Suzuki, Chartered Financial Analyst and an investment strategist at Schroders. And again, Schroders is an independent firm, but you have a collaboration with Hartford Funds. So we appreciate you hopping on, Dan. Welcome to the Lebenthal Report.
Very excited to be here, guys.
Thank you. Thank you. So look, you listened to the opening, I assume. So let's just start there. Is there anything that Dominick and I talked about a few minutes ago that you would disagree with, or you could add color to? Kind of what were you thinking as you heard Dominick and I, going back and forth about what's been happening recently?
Oh my God, you basically touched on so many topics. I mean, where do we start? I mean, we could just do a whole segment right there. I think what struck me was one of the conversations you guys were having is about sort of year-to-date performance, and I think you actually have to go even farther. If you go back, there was actually something that happened starting on right before Thanksgiving, sorry, right before Halloween, was right around the change. If you look at performance since then. Basically the Magnificent Seven, the biggest tech stocks in the S&P are down about 10% or close to it. Whereas you look at the equal weighted S&P 500, you're actually up 8%. So some of the divergences you were noting within the market are actually, longer trends and actually bigger in magnitude, than what you guys were citing. And I think, a lot of the things you pointed to, made a lot of sense. And with regards to, the topic of AI bubble, no bubble, I completely agree with you. I think we should be extremely bullish on the outlook for AI to change our lives. And I think there are a lot of parallels when you look at historical technologies and innovations. Typically they do have game-changing, impacts on all of our lives. But there's something where you have to separate, the story from the investment. I mean, you mentioned AOL.com. I mean, if you were investing in 1999, 2000, the story was very clear. We were going to use a lot more computers to get on the internet. We were going to use a lot more bandwidth, and we're going to do a lot more on the internet. Well, if you extrapolate that, well, then the obvious things you should have bought were PCs, because that's what, the interface, the Microsoft is the software that powers the PCs. Intel is the engine of the PCs. AOL.com is sort of our software interface to the internet. And then you have Cisco and Oracle that sort of managed, the what was now the cloud, but the cloud didn't exist back then. And so that's who you should have bought. And those are the biggest and most expensive names within the S&P 500 from a market cap perspective. And if you fast forward, internet did change our lives, but those were all not the right investments to have made at the time. Those all took you basically 15 years to make your money back. Who should you have invested in? Well, eventually the names were, again, Microsoft, yes, although they went through a big roller coaster, but it was, it was as the players we see today, NVIDIA, Meta, which is social media, e-commerce. It's just a very different, set of names than the ones that were sort of the obvious winners. And I think that's going to be, somewhat the same story today, is where we should be very bullish on, the impacts of AI. But I think maybe it'll become something like the internet, where we don't actually talk about the internet. No one says, "Oh, I got to buy internet stocks." You actually buy, applications where embedded in all that, a building block of all that is the internet. Just like AI will be embedded within all the tools that we use, and the eventual investments that we should be making based on that.
Dan, you brought up a couple of names, and I'm not going to get into the company specific. I don't want to do that to you. But you brought up a Microsoft, and I think of a ServiceNow, and these software companies have just gotten decimated. I mean, I had to look over it twice to confirm that the number is correct. Microsoft, which was one of the leading companies in the AI space, is down over 27% from its all-time high. The ServiceNows and some of these other companies are down almost 50%, all because AI is going to take over the software world. You want to comment on that? And then I'll give you a quick follow-up question on it.
Yeah, absolutely. I think, this is one of those classic examples where narratives have taken over the market, and you're seeing, the baby is being thrown out with the bathwater. I mean, certainly when you step back from everything, AI does represent a big risk to a lot of the software, space. Why would you pay, a subscription for this dedicated specific tool when AI can do it for free or for much cheaper? That's sort of the narrative that's taking over, where I think the baby's being thrown out with the bathwater is that some of these software tools are actually partnering, with the AI companies, and they're actually creating an enhanced product set. So it's not so much that they're going to get disrupted by AI, but they're actually partnering with them. I think that's what's, in some cases, I think that's what's being missed. So I think if you have, a really, astute investor, that's looking stock by stock, this is kind of where, active management makes sense. I mean, if you go buy the IGV or whatever sort of software ETF you want, that's just going to capture the overall space and sort of the macro risks to that space from AI. But if you want to pick out the specific opportunities where companies are going to actually benefit and are actually going to turn out to be good investments, there probably are going to be some in there. And so I think that's where you need to differentiate. And I think, right now, there's no differentiation. They're all going down, and you're actually seeing, that the sort of trend that started with software is now sort of spreading out to other industries. So software, then it was financial services. Most recently, it's trucking stocks. I mean, basically, the reason that the market's getting a lot more choppy is because they're worried about more and more parts of the market that are being disrupted away. And I think that, in that volatility is going to come opportunity to actually find those the companies that aren't going to be as disrupted as what the market's saying.
Mike, can I do a quick follow-up question?
Yeah, absolutely.
Just real quick. So On that same topic, same point, as far as I know, now one single major software company has announced lower earnings or lower revenue based on their loss to AI technology. In fact, as you just brought up, they're talking about how AI can augment their software. Have you heard, seen anything different? And when is that other shoe going to drop then?
No, absolutely. I mean, I wish I could sort of pull up like a Bloomberg screen, to share with you, because if you actually pull up, the earnings forecast for the names that you mentioned and the rest of the other peers in that space, you're actually seeing those earnings forecasts are going up, and some of them at a pretty good clip. And so there's no evidence that those earnings are being disrupted today. Now, clearly, we have to take that with a grain of salt, because as you look forward, there are some areas that are at risk, right? So I think, the thing to distinguish here is that, some of these AI tools are going to make it easier to interface with the data. So therefore, if you have a software program where you're selling 500 licenses so everybody can, interface with the data, probably need less software licenses down the line, but you still are going to need some interface with that data, which then can be sort of enhanced through AI. So maybe it's just a different sort of business model and revenue model. But I think that the reality is, in a lot of cases, again, because of the enhanced product, you are going to see, those earnings aren't going to be as disrupted as forecast. And certainly, you're not seeing anything in the data that suggests they're being cut today.
Yeah, and to that point, Dan, it's not like, you mentioned a number of companies, like AOL is a great example. But one of my favorite examples of that period is Blockbuster, where Blockbuster knew Netflix was coming, right? They knew streaming TV was streaming video was coming, and they did nothing to prepare for it. I can imagine we're in an environment today where these software companies are not a little quicker on their feet. And as I think you alluded to, are trying to adapt now to this new world order.
Yeah, I think you're right. I mean, we have to remember that Netflix was an adapter as well. I mean, I was an early subscriber, getting the DVDs in the mail, right? You could have three and then you return one in the mail. That was the Netflix original model. So that's one of the great examples of something where they saw the disruption potential coming and they pivoted their business model to the online streaming service. And I think that in a lot of these cases, you're going to see the software names do the same. So, picking those winners, that's I think that's a very difficult task right now, because everything's changing so much. But that's why you should keep an eye on this space and look for those ones where they are down 30, 40, 50%, yet, they're not going to see as much disruption as what the market's pricing in, for sure.
And just tell me if I can. And I still think, as I said earlier, we don't know who the winners and losers are. We're not going to know for probably 18 to 24 months. So I still maintain that this sell-off is just extremely premature and extremely overdone.
Yeah, I think you're right on a short-term basis. I mean, one of the things that you see historically is that, you don't see, such a widespread collapse and pricing in of a negative narrative while the growth fundamentals are still improving, right? So you guys noted that earnings trends are actually quite strong. I think that there's a lot of legs for those earnings fundamentals and economic fundamentals over the next couple of quarters. So it's unlikely in that type of environment where earnings growth is actually accelerating and broadening out that you're going to see, this huge overall collapse being taken down, by some of the software names in the space. So I think that, and to your point about the uncertainty, I mean, who knew that, an online bookstore, was going to be the biggest retail giant, e-commerce giant in the world. So it's like we have these examples of, Amazon going from a bookstore to e-commerce, from Netflix going from a, mail-in DVDs, company, to a streaming giant. Like, and who would have predicted that at the time? You couldn't predict it because it was a different business model. So I think, we have to your point, Mike, I think we have to be very deferential and recognize that we don't know who the exact winners are going to be and what that business model is going to be. and I think that's where actually it makes sense to be a little bit cautious here from a diversification standpoint. A lot of people have basically gone all in on these exciting stories and left sort of diversification, in the back seat. I think, last year proves it, this year proves it. I think having prudent diversification, makes a lot of sense more than ever. The closer you get, to later in the cycle you get, the more expensive the areas of concentration get, the more I think diversification makes sense. And I think that people are starting to wake up to that idea today.
And then maybe just to put an exclamation point on it, and then we can move on. But I think of ourselves as a pretty decent sized financial services industry, and our software budget, CRM, everything else that we do to run the company is pretty hefty bill. Man, I would love to cut that bill in half. But the compliance issues involved with that, of changing the operational issues that we would put in the company at risk, there is no way on the planet we would switch our whole operating system to a chat GPT or one of these other programs in hopes of saving a few dollars. It's just not happening. What I do see happening is the same software companies we're partnered with are augmenting the services to us by incorporating artificial intelligence. So I think that's the wave of the future, and maybe this whole area is a little bit overblown.
Yeah, I think you're right. In a lot of cases, that's certainly the case. I think what the market is doing is, shoot first, ask questions later. 3 years down the line, 4 years down the line, I think what's happening is kind of interesting, because one of the bull cases on owning all these names at any price was that they're such great businesses. You have subscription models, so you get sticky revenues with a lot of visibility, and they're actually not capital intensive. So they don't take up a lot of capital. They're capital light. And so people would slap on, a much higher multiple than would normally be prudent, because of all these positive attributes. But I think we have to recognize that a capital light business also doesn't have the barriers to entry and the moats that a capital intensive business does, right? So I think, I think in some respects, I think, a lot of this negativity is overdone on a short-term basis. But I think some of the positivity, that we've seen over the last few years with regards to software names, was also misplaced in some cases. And that's where you're seeing sort of the rubber meet the road, is like there's definitely babies being thrown out in the bathwater. So there's opportunities on a positive end, but some of the, will pay any multiple for these software names, that's getting called into question. I think part of that is healthy as well.
So Dan, switching gears, we would be remiss if we didn't spend a good chunk of time talking about the international markets. When we have Schroders, with us on the show, one of the leading, international investment banks and researchers there are. So, international has really come back into vogue, especially last year, spilling over into this year, both domestically and emerging market. I know it's a long answer, but what's the why behind it happening now?
Yeah, well, I think there's a couple, different reasons. I mean, first of all, the valuations last year basically hit a record dispersion, meaning the US's valuations relative to the rest of the world had never been greater, than they were last year. And so we all know that valuations are a terrible timing indicator. You probably could have said the same thing the year before, and probably the year before that. So the valuation discrepancy alone doesn't answer the question, but it does. I think it's more of an indicator of risk and of long-term, return potential. And so the risk tells you that when something's very, very expensive relative to everything else, when things change, and who knows when that will be, you have a lot more, to drop, and vice versa. When something's very cheap, and people change their mind about how bad things are, you have a lot more potential of re-rating higher. I mean, that's just kind of, the story of markets. I mean, to some extent, you can almost take, the other fundamentals out of it and understand that returns are often greatest where people don't want to invest, and risks are often greatest where everybody wants to invest. And so to some extent, that was sort of the backdrop. And then when you layer on, the earnings dynamic and the geopolitical dynamics, I think that's where it all came to a head. So I think last year, one of the biggest catalysts for, international outperformance was the weakening of the dollar. we saw, the dollar really start to decline in a meaningful way after basically 15 years of significant appreciation, right? And so, the dollar depreciating, naturally gives a tailwind to international performance. Because if you're a US investor and the dollar, is worth less relative to everything else, if you price back foreign, stock prices in US terms, you've already made money, simply from the currency, let alone the fact that there's other dynamics at play that are driving that. Typically in a falling dollar world, liquidity is improving. And some of the big beneficiaries of that improving liquidity are emerging markets and other regions around the world. Now, that's sort of the currency and liquidity side. And then the other aspect was sort of a earnings and growth fundamental dynamic. And people were so bearish on, on investments outside the world, and rightly so to some extent, having basically internationals basically underperformed for the last 15 years, no one wanted to own it. But then, when growth just got what came in better than expected, that was enough to see huge re-ratings. And so one of the big catalysts was Germany. They basically passed a bill that said they were going to do a lot more fiscal spending. And a lot of that, some of that spending was going to, they took the caps off their defense spending budgets as well. And so, having, such a change in philosophy from such a fiscally conservative country like Germany, really changed the sentiment on the growth outlook for Europe. And then you're seeing, different dynamics around the world where China is bad, but less bad than feared, particularly from an earnings perspective. And then you have, areas like, Taiwan and Korea, which are also sort of neglected, beneficiaries of the AI story. Taiwan is basically one company at this point, and that company is basically has a monopoly on, semiconductor manufacturing, right? So you have these stories that were neglected and underappreciated that were now, starting to get noticed. So I think putting all those together, it really, made the case for internet people to start to reallocate into international. At the same time, there are concerns about, the growth outlook for, the biggest driver of U.S. earnings growth, which is, the big tech stocks, right? I think one of the things that you guys have probably talked about in this show is that when you look at Mag 7 performance last year, only 2 of those Mag 7 outperformed the S&P 500. The rest underperformed. And so that splintering of that historical correlation where, the AI rising tide raises all ships, start to change, and people start to distinguish, between, teams within the AI sort of stack, and then the overall outlook, and then also starting to question, the incremental return on all this huge CapEx that they're announcing. So I think it's both things. The people start to recognize that there was some splintering of, the relationship between, the U.S. big tech stocks, as well as, there were some potential risks with, the bullish outlook on the back of all that spending. At the same time, international was coming in a little bit better than feared. And I think that dynamic really, swung the seesaw in the other direction, if you will. And as again, happening this year, combined with I think Dom mentioned this as sort of the broadening out story, that's also benefited international this year as well.
Let's give you a chance to take a break and catch your breath. That was a great answer. And we're going to take a quick break, and we'll be right back with Dan Suzuki, chartered financial analyst and investment strategist at Schroders. All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our guest this evening, Dan Suzuki, CFA and investment strategist at Schroders. Dom, I think it's your turn. I'm just going to throw it over to you.
Yeah, maybe just to kind of put an exclamation point on the international trade. So, Dan, we were looking at this picture well over a year ago, and we were really concerned that the tariff effect would be kind of negative on international markets. Logically, if these foreign companies were now going to have to pay a premium to sell into the US market, they probably wouldn't be able to sell as much, and their earnings would go down. And as you kind of touched on, they actually was the exact opposite. Did they all kind of wake up and start talking to each other now, going, hey, we can't count on the US, so maybe we're going to sell our products to each other? Because it just seems all of a sudden, what Europe, the Southeast Asia, South America, everybody's talking to each other now and trying to make deals with each other.
Yeah, I think you're absolutely right. I mean, that's one of the, the risks from playing hardball, which is what the US policy has basically been doing, is that, by in some respects alienating, all these other countries, you do get better trade terms, but you are also sort of making people question, how much they can rely on you as a trading partner. And so as a result, you're seeing, more sort of trading deals happening with, between countries outside the US. And so, I think, that dynamic, it puts some risk, and you're also seeing, effect with respect to the dollar. If we're, if you can rely less on, the fiscal sort of prudence of the US government, if you can rely less on your US bank accounts because they might be frozen for whatever reason by the US government, then maybe it makes sense to have less of your reserves held in dollars. And so that's not a new trend. It's just maybe being catalyzed, right? If you look at the share of, foreign currency reserves made up by the dollar, I mean, it's been declining for decades, right? So this is not a new story. But I think this sort of the recent events of the past couple of years really catalyzed that story and put more downward pressure on the dollar, which is, what we talked about, in addition to, the trade deals. So yeah, I think there's a longer term risk, now happening as more countries outside the US start to band together and create trade deals where the U.S. isn't involved. And so I wouldn't read too much into that, but it's just something we need to be mindful of. So I think, another reason, all the more reason, I touched on this before, to have diversification within portfolios. And so, when I think about it, if portfolios, equity portfolios today are tend to be dominated by U.S. growth names, which are great, companies, having probably the most efficient form of diversification relative to US growth is international value, because it's basically as far as you can get from US growth. I mean, US, the opposite's international growth, the opposite is value. So international value, and you guys were talking about value, how it's sort of been this, value is this always perennially disappointing trade. Well, that's actually more of a US phenomenon. And I think it's been sort of part of that reason for that, constant disappointment of value relative to the growth is just the strength of the AI story in the US. If you actually look internationally, value has been outperforming growth for basically like the last 5 years. And so what I like about the diversification into international value relative to people's, concentration in US growth is that you've gotten, basically, if you look at 5-year returns or 3-year returns, international value as a style category has given you basically the same returns as the S&P 500 over that period, but without the concentration in sort of the AI story. And so I think that's, to me, is a pretty efficient way to bring diversification back into the portfolios.
Dan, I think we just says worth repeating. The international value sector has outperformed the S&P 500.
Yeah, it depends on the day, right? Because I mean, the returns are neck and neck if you look at like a 3-year basis or 5-year basis. So depending on what happens the week, but the point is, yeah, they've given you very similar returns if you look at a 3-year number and 5-year number. Now, part of that, to be fair, is because last year, the divergence was so big. But yeah, so, for years, people have talked about diversification because anything you put in your portfolio other than the S&P 500 was a drag. But my point now is you can get efficient diversification without it being a drag. I think that tells you this is it's probably a good time to at least, consider having some of that in your portfolio.
Hey, Dom, you have a good little fun fact for your wedding this weekend when you're making small talk. So,
Um,
so
go ahead.
go ahead,
My turn.
go ahead. Yeah.
So I love this conversation about diversification because we classically see a client on board with us and they think they have a diversified portfolio. I had one today where they had the S&P version from Vanguard, they had the S&P version from BlackRock, right? So that they thought had a diversified portfolio. So what is if I can give you a really loaded question, what is a diversified portfolio look like?
Yeah, I think a diversified portfolio has a lot of different levers, right? So when one thing in the portfolio is not working, other things can be working. I mean, that's kind of how diversification works. People think it's based on number of stocks, or number of investors or number of funds, but it's really not. It's just how correlated are those individual investments or individual funds within your portfolio. That's the big problem, is like the S&P 500, ETF, if you will, has basically exposure to 500 names. But as we know, three of the 11 sectors in the S&P 500 make over 50%, of that value. And by the way, those three sectors are all dominated by technology. And so basically, if you buy an S&P 500 from a sector perspective, it's a pretty concentrated technology bet. We talked a little bit before about the Magnificent Seven. If you add up the market caps of those 7 stocks, you're basically get upwards of, 35%. So a third of your diversified portfolio is really just a function of 7 stocks. I mean, that's not diversification. It's really, if the tech story is not working, for a week or a month or a year, what's going to pick up the slack? If interest rates go up a lot, what's that going to do to your portfolio? And do you have something else that's going to be a balance? And so to me, a diversified portfolio has equity diversification. Again, balance the U.S. growth concentration with international value. I think with emerging markets also makes sense. Make sure your sectors are well diversified. But then, classically, you have stocks in your portfolio and say you have bonds in your portfolio. One thing that people I don't think fully recognize is that the last 5 big stock market corrections that we've had, bond prices went down in 4 out of those 5. And so the typical, zigzagging that bonds have done, they just hasn't been the case post-COVID. And the reason for that is in a sticky, high inflation environment, bonds act very differently relative to stocks. And so I think people need to change the way they think about bond investing a little bit, to manage that interest rate risk and manage the credit risk, which is a very different sort of scenario than we've been in, the prior like 2 or 3 decades.
So Dan, speaking of diversification, I want to go back a few minutes when you talked about the dollar going down, because central banks have been selling them. The central banks have also been accumulating gold, haven't they? And has that story been part of the explanation why gold has virtually doubled over the last several years?
Yeah, absolutely. Absolutely. So, I mean, for up until a few years ago, gold followed a pretty reasonable, dynamic. You could predict what gold prices were going to do based on what was happening with interest rates and inflation. To some extent, it was kind of like buying, this is a bit nerdy, so I'll be very quick, like a 30-year, zero coupon tip, inflation protected bond, right? Because if you buy gold, you get no coupons. So your hope is to sell it, way down the line, let's just say 30 years from now, at a higher price. And so that makes it kind of like a zero coupon bond, with a store of value because it's a real asset. So that's sort of the historical relationship with gold, is like it had a pretty good relationship with inflation and interest rates in that intersection. What's happened over the last few years is that the central bank buying was so big and so price elastic, basically price indiscriminate, meaning central banks decided, they woke up one day and they said, we don't like what's happening in the world. We need to buy more gold to diversify our dollar. And we actually don't really care what the price of gold is. We just have certain targets to diversify, our reserve holdings. And so they just kept buying. A lot of that buying came from Asia, but, generally, central banks have been buying indiscriminately for the last few years. And so, and you have a huge indiscriminate buyer in markets, you tend to see prices move higher. And so I would say that was the explanation for a big part of the price appreciation, not to mention that gold is also sort of a play in uncertainty. And if you look at what's happened with global geopolitical policy over the last year or two, you can't say there hasn't been a huge spike in uncertainty. So central bank buying plus uncertainty, which are not unrelated to each other, really pushed the price of gold higher. Now, I would say that the most recent leg of the gold, move higher up until, the recent sell-off, if you will, was actually, people jumping onto the FOMO trade. People like charts that go higher, especially when they go parabolic. And so then you get people coming in to speculate. And I think that, actually what was interesting is last year, central banks bought, in terms of volume, not in terms of price, but in terms of volume, central banks bought something like 20% less volume of gold last year than they did the year before. But we saw prices just keep going higher. I think what made up the gap there was sort of the speculative investors that came in to jump on that trade. And I think that's the concern, is that, whenever, the speculators come in and take over the price action, sometimes the historical relationships can change. So people buying gold is this sort of, hedge in their portfolios. On a long-term basis, that might work out, but it may not be such a defensive hedge in the near term, simply because, people are using liquidity to buy gold. And so when liquidity dries up, they're going to have to sell that gold along with their other risk assets. And so that might not be what people want. They want, when their stocks are going down, their risky assets are going down, they want their gold to be going up. That might not be the case, on a near-term basis because of the sort of the speculation.
So I don't think I was going to ask this question, but I'm going to give it a shot anyway because you kind of hinted at it. So we had Bitcoin, these cryptocurrencies that were supposed to be digital gold or digital currencies or whatever. I guess this idea of the speculation going on, what's happened? Can you just, if you have an opinion?
Yeah, so
What the feeling.
Bitcoin and cryptocurrencies, the non-stable coin cryptocurrencies are basically a measure of liquidity and speculation. They can't be gold. It can't be a digital gold, because gold, is a real asset. It's something you can hold. And so, it's whether you like Bitcoin or you don't like Bitcoin, it's certainly not a real asset. And so, in my mind, it's more of a pure measure of liquidity and of speculation in markets. So when you actually look at the pricing of Bitcoin, it actually tracks very, very closely with other measures of liquidity and speculation. So if you plot it versus the price action of recent IPOs, of microcap stocks, of SPACs, of unprofitable technology companies, for most of the time, they track very, very closely. And that should make sense, because they're all measures of liquidity and of speculation. So as liquidity comes out of the market, and speculation declines on the back of that, you typically see, those will all fall in unison. So, I think at least on a trading basis, that's the case. Now, I know that the crypto bulls have all their sort of reasons lined up for why it's worth X amount. But I think at least when you look at the price action relative to other, similar liquidity-driven, assets, it kind of tells, to me, it's a pretty clear signal. And so what's happened? Well, the liquidity trade, to some extent, has splintered a bit. And so that's why a lot of these, as the market has called into question, some of these investments and the viability of them, partly due to disruption, partly due to, decreasing profits and, lower returns on invested capital. People's risk appetite is actually decreasing a little bit. Now, one thing that is going to be interesting to monitor is whether or not, a couple months ago, it was sort of, or a month ago was basically peak liquidity. Not forever, but on sort of a multi-year basis, it was peak liquidity because, we had the tailwinds of the government reopening and liquidity coming back to the market. We had, my old firm, B of A, publishes the fund manager survey. They had fund manager cash levels hit an all-time low. You had basically all these, most markets in the world. So you look at global market breadth, I think 85% of markets were, trading above their 200-day moving average. I know, Dom, I know you love the technicals. So you had all this breadth, you had all this liquidity, you had the huge expectations of rate cuts. This all happening simultaneously, and those sort of liquidity driven assets are doing well. Not that I don't think the liquidity is going to fall off a cliff. I think, again, because the growth dynamic is pretty supportive, at least for the next couple of quarters, that liquidity does have support, but liquidity directionally, has been declining. And so it calls into question, was what we saw a month or two ago, was that, peak liquidity on a sort of relative basis. If that's the case, that's not a great backdrop for Bitcoin, or sorry, other cryptocurrencies.
Dan, we have 4 minutes before we have to close out the show. And I think a great way to put a bow on this conversation is you recently wrote a piece, and I'm going to paraphrase, but we've kind of seen the movie before, whether it was the boom in Japan in the 80s and the internet build out in the early 2000s. So why don't you spend the closing segment just talking about that a little bit? And, and this AI thing, it ain't going to last forever, I guess is the point, correct?
Yeah, absolutely. So the piece was called So Obvious It Hurts. And, basically walked through the last 75 years of the biggest investment cycles over that period. And so it walks through, in the 60s, and in the 60s, you basically had the Nifty 50, which were the 50 biggest stocks in the US. Then it goes into, Japan in the 80s, and then it moves on to US internet stocks in the 90s. And then it moves to emerging markets in the 2000s. And then here we are in sort of this AI cycle. And so, when you look at each one of them felt inevitable. The closer you got to the peak, the more obvious it seemed that you should just buy these stocks and nothing else, because they were just so dominant in terms of their earnings growth, their historical price performance, everything. The story sounded so good, and in many cases it was driven by innovation. Japan in the 80s was certainly an innovation story. They reinvented auto manufacturing. They were the leaders in sort of PC, gaming, portable consumer electronics. Basically everything that you thought of with regards to technology was basically dominated by Japan. Who would have thought? And by the way, fun stat for your wedding, Dom. Fun stat for the banter at the table is that Japan's stock market was the biggest in the world, in 89, 90. It got up to 45% of the global stock market. Why? Because that was the obvious thing that everybody should own. So that was Japan, and then it was US internet stocks, because that was going to disrupt everything out there. Then it was emerging markets, because that was the driver of global growth. And here we are with AI. And I think the lesson is, historically, no matter how good the innovation, how disruptive the technology, everything has an upcycle, everything has a boom, and everything has a bust. Not saying that it's going to bust tomorrow, but nothing goes up forever. And the closer you get to the peak, the more obvious it feels that you should just, own that asset. But ultimately, it doesn't work out well for the people who buy in toward the end. So that's sort of it's got some nice visuals and some nice descriptors. So if you're interested, I highly recommend you check it out.
Is that investor friendly? Is that investor user friendly?
I try to make all my pieces investor and non-investor friendly, meaning that they're pretty short and pretty readable for everybody.
Yes. So if you or Dan could get us a copy of that, Dan, that would be amazing.
Absolutely.
And unfortunately, as Dom said before, we could probably have this conversation for another 2 hours, but we do have to stop there. And we do thank you for your common sense input and insight this evening.
I appreciate you joining us back, and I hope when we call the next time you agree again. Thank you for helping us and educating our clients.
It's my pleasure, guys. Let's do it again.
And we'll be back next week with a new edition of the Lebenthal Report. Have a good night, everybody.